Today, I'm going to share two cheap dividend stocks that I'm buying right now. This is in my personal long-term dividend growth stock portfolio. The current value is $241.7 thousand, and it has a 66% total return. So I'll give you a full update on this account and what I'm buying right now, plus the dividends I earned already this July that paid me over $608. With that said, let's roll the intro and get into this portfolio update video. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I will be using dividenddata.com, which is the best research tool for dividend investors. I've been working on this a lot lately, and you'll see new updates roll out soon. Plus, I have a secret project, we'll call it Project X, that is in preparation for the months to come. So first, let's just give an updated look at my portfolio. My top holdings are Microsoft and Visa. These are the dividend growth stocks that I consider to be core positions of my account. As you can see, I have a 100% total return on Microsoft. That was purchased mostly in 2022 and 2023. And I have a 39% total return on Visa, the bulk of which was purchased in early 2024. In a similar vein, I have Alphabet, ticker symbol GOOGL. This is the parent company of Google, and this is a new position I've been building up a lot in early 2025, especially during that tariff crash. And you can see it's now my fourth largest holding and probably will be the third largest soon. I have a 14% total return so far, which is pretty good because it's a new holding. However, this is a dividend growth portfolio, so I also have some high yield names in that account that continue to raise their dividend payments year after year. As an example, we have the Altria Group, ticker symbol MO. I have a 68% total return right now, and that company pays me $2,361 a year in annual dividends. I've owned this stock for a while, and you can really see the snowball effect at work. Based on my initial dollars invested into the stock, I have an 11.86% yield on cost. And from reinvesting dividends year after year, I've earned 114.75 additional shares in the company. This is by far my biggest dividend payer, and I just got paid a $580 dividend from MO. That, along with $28 from Salesforce, gave me a $608 month. And this really is an example of the snowball effect at work. You can see my dividend income from MO growing from $6 in 2020 all the way up to $580 now. Of course, money was added during that time, but in the past year to year and a half, I haven't invested really any new money in MO other than reinvested dividends, and my dividend income per payment has increased by nearly $100. That's because every single time I'm reinvesting that dividend to earn more shares, and there's been dividend increases in that time. Another great example of this dividend snowball effect in my portfolio is with ExxonMobil. I have an 11.98% yield on initial dollars invested on the stock and have 32.85 shares from dividend reinvestment. This company pays me $676 a year. And you'll notice that I now have two additional high-yield midstream oil and gas stocks in my portfolio. That's MPLX and HESM Midstream. MPLX is now my second largest dividend payer with $852 in annual income and an 8.02% yield on cost. And HESM Midstream is about to eclipse ExxonMobil with $670 in annual income and a 7.8% yield on cost. And these are the two cheap dividend stocks I'm buying right now. And I will soon explain why and share what I've been buying so far in July and my plans buying going forward. But before that, let's talk about how these buys change the income in my portfolio. If we take a look at my projected dividend income, you can see that's now up to $5.8 thousand, which is $489 every month on average. And this month of August is now up to $458 in the month. And you'll notice that used to be my lowest dividend month by far at $86. So adding these midstream stocks really have beefed up my current dividend income. And that's because they trade at a cheaper valuation, so they have a high dividend yield right now. But that doesn't mean they're bad stocks. You don't always want to go chasing cheap companies, but these are high quality businesses with reliable and growing cash flows, and their dividend payments are growing at a high rate. It is a rare combination of high yield with high dividend growth, and I'll dive into that soon. So far this July, I've already bought $1,563 worth of stocks. That includes 19 shares of MPLX at a cost per share of $50.45. That gives me a 7.59% yield on cost. And I'll give a brief overview of my thoughts on the stock, but if you want a really deep analysis, I did a full stock review video last month. I'll put the link in the description and pinned comment of the video. As you can see, the current dividend yield is 7.53%, and the company has growing earnings per share and cash flows over the long term. And expectations are this will continue to grow at mid to high single digits every single year. If we take a look at their dividend, you can see that it is sustainable based on free cash flow. However, this is a partnership, so you really should be looking towards distributable cash flow. So with these kinds of midstream oil and gas stocks, I always recommend diving in a little deeper into their actual financial statements and investor reports. And I explain this in my MPLX and HESM reviews. But let's take a look at this dividend growth. As you can see, the 10-year compound annual growth rate of the dividend is 8.84%. And the 3-year CAGR is 10.7%. The most recent dividend increase for MPLX was 12.53%. This is a rare combination of yield and dividend growth. So far this July, I also bought 16 shares of HESM at a cost per share of $37.82. This gave me a 7.51% yield on cost. As we take a deeper look at HESS Midstream, you will see that it went up 6.74% today. And that's because there was some big news around Chevron acquiring Hess, not Hess Midstream, Hess. And I'll talk about that a little bit in the video because I know a lot of people in our community had questions about how this impacts Hess Midstream. But first, let's go over some of the quick dividend metrics. We have a dividend yield now of 6.92%. And you can see again, this is another example of high dividend growth with high yield. The 5-year CAGR of the dividend is 10.49%. And Hess Midstream actually increases their dividend every single quarterly payment. If you want to learn more about the company, last month I did a full stock review on Hess Midstream. So go watch that if you want a full deep dive. I'll leave a link to it in the description and pinned comment of the video. So now let's talk about that acquisition news and why Hess Midstream may be up over 6% and whether or not this is even a good thing for Hess Midstream and how it impacts us as investors. This acquisition has been years in the making, and it was only being delayed due to a legal dispute with ExxonMobil, where they were trying to block basically the Chevron-Hess merger. But now that court case is finally over and the acquisition is set to go through, and that is an all-stock deal valued at approximately $53 billion. So what that means is if you're a Hess shareholder, you will receive 1.025 shares of Chevron for each share of Hess you own. So instead of being paid cash, you'll just become a shareholder of Chevron. So what does this mean for Hess Midstream? If you remember from my full stock review video that Hess is the largest owner of Hess Midstream, and their business is overwhelmingly long-term contracts towards Hess's production. So what this means, once the merger goes through, Chevron will become the largest owner of Hess Midstream, taking over Hess's ownership stake. And in other news, we have some Chevron leadership now on the board of HESM. And the founder of Hess is no longer going to be the CEO of HESM or Hess. Instead, the longtime CFO of Hess Midstream is now going to be the CEO. So this is very good in terms of stability. And if you remember from my full stock review video, HESM has very long-term contracts with Hess that Chevron is now taking over. So they really aren't at risk of any business changes hurting their economics. And I think the reason why Hess Midstream went up over 6% on the day is because having Chevron behind it and being financially involved in the company is a good thing. Chevron is nearly 5 times the size of Hess. Hess was about a $50 billion company. Chevron's a $262 billion company. So there now is just a lot more financial power behind them. So although it's fun to see a stock that you own and have been buying go up a little bit on a day, I'm actually pretty disappointed because I was planning on buying more Hess Midstream, and now the stock's a little more expensive. So I actually put in some new buy orders for the company starting around the mid $38 range. So I'm hoping over the next few weeks and months, the stock may sell off a little bit and I can keep building up my position. I also am still buying MPLX in the low $50 range and high $49 range and below, of course. And both of these I want to be core high yield positions in my long-term dividend growth stock portfolio. I'm hoping they stay low and probably go lower by the time August comes around and I get to reinvest those dividends. And I think these two stocks will have a great snowball effect in the years to come. If you want to track your portfolio and research stocks just like me, head over to dividenddata.com. I designed this tool specifically for dividend investors. It is everything I need to make high-quality investing decisions. The link will be in the description and pinned comment of the video. And if you enjoyed this portfolio update, make sure to leave a like and subscribe to the channel for future updates and stock analysis videos. Thanks for watching, and I'll see you in the next one.